Well, markets are still expecting the Fed to raise the interest rate once again when the Federal Open Market Committee meets next week. And that's despite last week's historic bank failures. Silicon Valley Bank and also Signature Bank over the weekend, the second and third largest bank failures in U.S. banking history. Yesterday, San Francisco-based First Republic Bank led the drop in bank shares, with shares falling about 60%. We did see them rebound then. All of this is happening as the Consumer Price Index report for last month was released. It says inflation is still high. You know that, with consumer prices up 6% from a year ago. Things cost more, but it has slowed for 8 straight months, so some good signs. Sultan Meghji joins us this morning. He's the former Chief Innovation Officer for the FDIC and professor at Duke University's Pratt Engineering School. Great to have you with us this morning. You say that we should have seen this coming. Explain.
Well, very simply, for years now in academia and in the banking system itself, we've been able to use machine learning and advanced analytics to look at balance sheets of banks to find these kinds of issues. So both on the side of the management at Silicon Valley Bank in particular, as well as on the regulatory side, we had the tools, we had the data. I'm really rather surprised that either party allowed some of this imbalance to exist and kind of get out of its control as much as it did.
So is it intentional if they had the numbers and the data?
It's, that's not for me to say. I'm sure, per the president's comments that, the people who caused this are not going to get away with it. I think it's clear that on the regulatory side, we need a more dynamic framework for how we manage this. We need to make sure that regulations are applied consistently and in a kind of a quantitative manner, numbers instead of opinions. And then on the banking side, I think if I'm a bank investor, I'm asking a lot of hard questions of my bank leadership team, especially for some of these banks that have seen such significant share price drops in the last 24 hours.
Well, it caused some panic, a lot of nervousness for sure. I spoke with former FDIC Chair Sheila Bair this week. She says she doesn't see any evidence in this case of widespread problems within the banking industry, but does it highlight the fragility of the banking system?
Well, I think one thing a lot of people don't really realize is just how interconnected the entire system actually is. And so a little ripple in one area can have big effects, as we've seen. 3 banks, going under is not necessarily something that would have normally caused this kind of ripple. The great thing is there are very few banks in the United States that had the kind of balance sheet mismatch and exposure to bonds, lending, and rate sensitivity that these 3 did. I think there are probably another 5 or 10 that we're all looking at very closely this week. But, beyond that, I don't see anything happening.
Well, and some of the things I'm reading this morning, the concern, at least on some levels, after the FDIC stepped in to cover the depositors, what happens if other banks run into trouble? Where's the line?
It's a great question. And because this is a rather one-off situation, there isn't really a line built in, between the deposit insurance fund and this new Fed facility. There's approximately $300 billion available. Surely we can absolutely extend that if need be, but that number was designed to cover not just the 3 banks that we were paying attention to, but then a potential couple more that might have some issues. I've tried to make it clear that, we have a very strong banking system. It's the safest and soundest in the world, but we shouldn't be at all surprised if a couple of banks don't make it through the next weeks, months, or even few years. We had almost 30,000 banks in the United States in the 1980s. Now we have, right about 4,500. And that number keeps going down by 1% or 2% every year. So this is a natural evolutionary process of the way we've structured the banking system, which incentivizes the big money center banks, the too big to fail banks, at the expense of regional and community banks.
Right. So if you've got your money with some of the big banks, you may be a little bit more protected. But what are CEOs, leadership at some of the mid-level, smaller banks doing right now to reassure their customers?
Everything they possibly can. They're really digging into the toolbox as much as possible. I'm hearing about bankers responding to text messages at 11 o'clock at night, manually running transactions and things like that. At the community and regional level, I think there's a lot of depository flow out of those banks into, the big money center banks. I don't think when we look back on this in a few months, So north of 80% of all consumer deposits already live in the top 6 banks. I think that number is going to continue to go up over the next few years because it's very clear that if you had your money trapped or still have your money trapped at one of these 3 banks, you haven't been able to get it out yet. You won't have that problem if you bank at one of these larger institutions. And so we're creating a concentration there.
I'm up against the clock, so just a real quick answer on this. Do you support slowing down or pausing another rate hike from the Fed?
Yes.
All right. Thank you for watching. Go to newsnationnow.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.